Welcome to the Deep Dive. Today, we're cracking open Wells Fargo's Q3 2025 results.
Yeah, and this is a big one.
More than just earnings, right? It's really the first proper look at them without that $1.95 trillion asset cap.
Exactly. That regulatory freedom, it really changes the whole picture. So our mission today is to look past the strong quarterly numbers.
We're strong.
Oh, definitely. But we want to analyze this aggressive new growth strategy they've kicked off. It feels like the turnaround's done, and now they're on offense.
Okay, let's start right there with the hard numbers then, because they do set the scene. Net income for Q3, $5.6 billion.
Solid. Up 9% year over year.
And the one investors watch closely, diluted EPS, came in at $1.66, nicely above what analysts were expecting.
It's a pretty compelling set of results. And importantly, total revenue was up 5% year over year. And it wasn't just one thing driving it. They saw gains in both net interest income profit from lending and fee-based revenues, things like wealth management, investment banking.
Right, that balance is key for, sustainable growth, not just a one-off quarter.
Exactly.
Okay, so strong results may be somewhat expected given the environment, but the real headline grabber here, I think, is the shift in ambition, this new profitability target.
Oh, absolutely. The medium-term target for return on tangible common equity, ROTCE,
They've raised it significantly.
massively, from 15% up to a range of 17% to 18%. That's quite a statement.
It really is. I mean, it signals they're not just aiming to be okay, they're aiming for best-in-class returns, right? Competing with the JP Morgans of the world.
That's exactly the message. It's management saying, we're back and we intend to lead.
So put that 17 to 18% in context for us. We know other big banks aim high, but why does Wells think they can hit this now? After years stuck, frankly, well below 10% sometimes.
Well, it really comes down to two things: operational leverage and shedding those regulatory constraints. Think about the resources, the sheer manpower and cost. Just managing that asset cap.
Must have been huge.
Enormous. Now that burden's gone and they've kept the efficiency gains they made over the past few years. So the idea is they can generate much higher profit per unit of equity.
And they'd already hit the old target.
Yeah, their old 15% target. They actually hit that in Q2 and Q3 this year. So, the bar needed raising. The old target was basically obsolete the moment the cap was lifted.
Okay, that confidence shows up in their forward guidance too, but there's one piece that made me pause a little. Net interest income, NII. The full-year outlook is roughly flat compared to 2024, around $47.7 billion. If they're growing loans now, which we'll get to, why isn't NII climbing faster? Doesn't that still point to margin pressure being a big factor?
It does, absolutely. That's just the reality of the current banking environment. You see, the Q4 NII forecast, that $12.4 to $12.5 billion range, yes, it's helped by loan growth and fixed-rate assets repricing higher. Okay. But the offset is higher funding costs. They're paying more for deposits, other kinds of funding. That squeezes the net interest margin, the spread between what they earn and what they pay. It's a constant battle right now.
Right, makes sense. Okay, let's pivot to the other side of the ledger. Expenses, non-interest expenses. You mentioned efficiency gains, years of cuts.
Yeah, significant cuts.
And yet, they've hiked the full-year expense forecast by $400 million up to $54.6 billion. How do they explain that?
It's a bit of short-term pain for long-term gain, plus, honestly, the cost of doing well in some areas.
Okay.
The single biggest chunk was about $296 million in severance costs in Q3. That's tied to these ongoing efficiency moves, right-sizing, removing roles, probably many linked to managing the old cap.
So that's the cost of getting leaner to enable that higher ROTCE down the line.
Precisely. Pay now to save more later. The other main bit was higher revenue-related compensation, mostly in wealth and investment management.
Because they had a good quarter.
Exactly. Strong markets meant higher fees and commissions for their advisors. So expenses went up because revenue went up even faster. That's what you'd call a high-quality problem.
Definitely a good problem to have.
Yeah. Okay,
let's dig into leveraging that lifted asset cap. That's what everyone's watching.
For sure.
It wasn't just symbolic. It meant they could finally cross the $2 trillion mark in total assets. First time ever? That's about capacity.
It is, and they're already putting that capacity to work. Look at the corporate and investment bank, the CIB segment, training-related assets there, up 50% since 2023. That's not accidental. It's very deliberate.
50%. Wow. So what does that CIB expansion actually mean? What are they doing?
It signals they're really leaning into what they call flow-based client business. So more market making, helping big companies with hedging, financing needs. But importantly,
Yeah.
this isn't a return to the really risky proprietary trading of the past. It's about being a reliable partner for corporate clients, generating fees, consistent NII, without taking huge speculative bets.
Got it. More service-oriented.
Exactly.
Okay, that's the institutional side. What about the consumer? We saw loan balances had their strongest quarter-on-quarter growth in over 3 years.
Yeah, momentum there too.
And the standout number, for me anyway, was credit cards. New accounts surging, 49% year over year.
Yeah.
Over 900,000 new cards in Q3 alone.
That 49% is massive. And it's a direct result of opening the taps now that the cap is gone. They clearly had the infrastructure ready.
Gut. Is that kind of aggressive card growth maybe a bit risky? Are they chasing market share at the expense of credit quality, especially if the economy softens up?
That is the critical question. Management's pretty open about it. Credit cards drag on earnings for the first, say, 3 years, acquisition costs, initial losses.
Right.
But after that window, they become very profitable, high-return products.
Okay, so they're planting seeds now, expensive ones, betting the economy and the consumer stay strong enough for the next 3 years for these cards to mature profitably.
That's the bet. They're taking on some near-term risk, you could say, because that long-term payoff is absolutely core to hitting that 17–18% ROTCE target. It's a big strategic lever they're pulling now they have the capital freedom.
High stakes. And they're also pushing hard in investment banking. Fees up 25% year over year. You mentioned talent investments there.
Yeah, they've been hiring aggressively in CIB, and it seems to be paying off. Their stated goal, top 5 U.S. investment bank.
Ambitious.
Very. But look at the deals. They advised on that huge Union Pacific acquisition of Norfolk Southern, $85 billion, one of the biggest deals this year.
That's a major win.
It is. It's not just the fee. It validates their strategy. Shows they can compete for those top-tier mandates now.
Okay, so lots of growth, lots of lending expansion. We have to ground this in credit quality, though.
Yeah.
Is the underlying consumer health actually holding up?
So far, yes.
Oh.
And that's crucial for this whole strategy to work. The net loan charge-off ratio, actual losses, it actually declined, both year over year and from Q2.
Decline. Okay, that's good.
Yeah, indicates pretty strong performance across most consumer loans. And on the commercial side, non-performing assets fell 2%, mostly driven by fewer problems in commercial real estate outside of the known office issues.
Right, the office subsector is still the weak spot industry-wide, but it sounds like Wells feels the rest of CRE is holding stable.
That seems to be the message. Stable outside of office.
Okay, let's talk efficiency again, because you tied it to the ROTCE target earlier.
Yeah, it's the engine, really. The cost cutting has been relentless. They expect $15 billion in gross saves between 2021 and 2025.
And we see that in headcount, right? Down 24% from the peak in 2020, from 276,000 people down to 211,000 now.
Huge drop.
Why does that multi-year efficiency drive matter so much now, specifically after the cap removal?
Operating leverage, pure and simple. They've squeezed more revenue out of each employee by getting rid of the complexity and costs of managing the cap while keeping that leaner structure. Every new dollar of revenue from CIB growth or those credit cards should, in theory, drop more efficiently to the bottom line. Less overhead needed to support it. That's what makes the 17% ROTCE seem plausible.
Right, less friction in the system. Okay, finally, capital. They are absolutely flush with capital. CET1 ratio at 11%. That's over $30 billion above the minimum required.
Massive buffer. Gives them tremendous flexibility.
And they signaled how they plan to use that flexibility, did they, with a new capital target?
Yes, and this is strategically very important. Management is now targeting a lower CET1 ratio, 10% to 10.5%.
Lowering the target. With regulations like Basel III Endgame potentially demanding more capital, how does that work?
Well, it's a confidence signal. They're basically saying two things. One, our risk management is better. Our business is simpler and more efficient, so we don't need to hold quite as much buffer as before.
Okay.
And two, we intend to deploy this excess capital productively, not just let it sit gathering dust. It frees up billions for more growth, like we've discussed, and for shareholder returns.
And speaking of returns, they were active there too. $6.1 billion in share buybacks just in Q3.
Huge number, and they expect a similar pace in Q4.
Why are buybacks so significant right now? It's more than just giving cash back, isn't it?
Oh, yeah. It's a strong signal about valuation. Management is saying, we think our stock is cheap relative to our future earnings power. Plus, mechanically, it boosts earnings per share. Fewer shares outstanding means each remaining share represents more profit.
So directly helps them on the path towards that higher ROTCE target.
Exactly. It's an immediate way to enhance returns per share while they execute the longer-term growth strategy.
So this whole shift from defense, big capital buffer, to offense, lowering the target, big buybacks, it really paints a picture of renewed confidence. They're acting like a growth company again.
Absolutely. What we're seeing here is really the culmination of a huge multi-year turnaround effort. Wells Fargo has gone from being stuck, constrained by regulation, to actively aiming for leadership again. That 17% to 18% ROTCE target is the banner they're flying.
It's an impressive transformation story. But okay, here's the final provocative thought for you, our listener. CEO Charlie Scharf acknowledged that hitting that ambitious 17–18% target depends on the medium term, which isn't, a fixed date.
Right. It depends heavily on the economy staying supportive, especially for that credit card growth to mature well. And it depends on how quickly and effectively they can actually deploy that $30 billion plus of excess capital.
Well, the question is,
The question really becomes, if they do deploy that capital efficiently into CIB, into cards, and maybe if the final Basel rules aren't quite as harsh as feared, how fast could they actually get there? Not just medium term, but maybe, the next 18 months. Could they really become the undisputed profitability leader? That massive excess capital creates a lot of potential upside. The market is definitely watching.
something to think about. Thanks for diving in with us today.
Always a pleasure.
We'll catch you on the next deep dive.